first hearing. As you know, the payday lending industry is now doing $7 billion a year in loans. There are now more payday loan storefronts in America than there are Starbucks, plus all of the online payday lenders, often charging 200, 300, even 400% interest. Now, when emergencies arise, people need access to credit, but payday lenders that build business models around trapping people in a never-ending cycle of debt are throwing bricks to a drowning man. Director Cordray, I know the CFPB is close to issuing its payday lending rules, so I want to ask you 3 questions about this process. First, can you describe the research and data gathering that the CFPB has done to try to figure out where to draw the line between preserving access to credit and trapping people in never-ending cycles of payday loans?
Yes. So here, as with arbitration, we've engaged in the most comprehensive research ever done by anyone on this marketplace. We've done 2 significant white papers, analyzed millions of payday loans across all types of lenders. And what we found is that the model here is to, in particular on payday balloon loans, is to get someone into a payday balloon loan, and if they had to borrow $300 today, the notion they're going to be able to repay $345 2 weeks from now is not very likely, although some do, and great for them, and maybe it works for them, but many others end up rolling it over because they can pay the $45 at the end of the 2 weeks, but they can't pay the $345, and they can never pay the $345. And by the way, you described these products as 200, 300, 400% interest rates. In Missouri, we have seen products, loan products that go as high as 1,950% rate of interest. You can actually lend where the fees amount to 75% of the face value of the loan. That's a $1,000 loan that becomes $18,000 or $20,000 by the end of the first year and goes on from there. And this is from a class action decision by a Missouri appellate court in which they read out of the record some of the actual instances of people who borrowed $100 and ended up paying back thousands of dollars and still owing thousands of dollars. That is not a recipe for financial success for people.
Yeah, thank you very much. Let me ask a second question around this. States currently have different standards for regulating small dollar lending, but the CFPB would create a single national floor. So states could still issue stronger payday lending restrictions if they wanted to, but they couldn't drop below the CFPB standard. Can you explain the benefits of having a single baseline rather than just a lot of different local rules?
Yeah, sure. In fact, this is the same approach we took in our mortgage servicing rules, where we established a baseline of requirements on mortgage servicers, not on states, by the way, but on mortgage servicers, and said that states were free to add further requirements on mortgage services if they deemed it appropriate to do so. And by the way, this is an approach that's been common in American law in our system of federalism. It's true of securities law, it's true of environmental law, it's true of antitrust law, it's true in many different areas of law where the federal government may intervene to a certain degree and set certain requirements on individual citizens and companies. The states are free to have their own regimes, and they do, and they set requirements on individuals and companies, and the 2 systems coexist. There's nothing unusual about this. It's been described as cooperative federalism, and it works reasonably well. It can be a little complicated at times, I suppose, but a federal system is bound to be a little complicated at times.
All right, good, thank you. And let me ask my third question here. The CFPB has been working in this area now for 3 years. You've been gathering data as you've described. You've drafted different approaches, talked about it with industry. Now certain members of Congress have proposed imposing an additional 2-year delay on your efforts. Can you give us some idea about the impact of that delay and estimate how many more families will get stuck in a debt trap during that time?
So I feel keenly already the amount of time that it takes to embark on a federal rulemaking in an area that is a baseline of no research previously. It's taken us several years to do the kind of detailed research that you asked me about and I described. It is taking us time to go through the processes in our statute, including a small business review panel and report and so forth. And we are now on the verge of actually proposing the rule, and it will take time to work through it and finalize it. I feel keenly that every day that passes, if you think a rule is going to improve life, and it may or may not, but if you think it is going to improve life, you'd like that to happen as soon as possible. And delay for delay's sake simply means that if there are harms here, and our research has identified harms to consumers, then they will go on. And that anybody should feel like that's no big deal means that they simply disagree with the findings around the country of what this does for people and for families.
Yeah.
And I can't agree with that.
Right. We're talking about perpetuating a lot of misery here.
Yes,
Yeah.
that's right.
Well, I want to thank you. I want to thank all of the people who work at the CFPB for their terrific efforts in this area. You know, I know that the payday lending industry hires a lot of lobbyists and they make a lot of political contributions to try to protect their multi-billion-dollar business. I also know that families that get cheated by payday lenders don't have lobbyists and they don't have political action committees, which is why the independence of the CFPB is so important. You know, I hope you will move quickly to complete your rulemaking on payday loans. You are the best hope for millions of American families to avoid these debt traps in the future. Thank you for your work.